With entrepreneurship and capital, what we're looking at are two trends here where we're pushing the envelope forward. And I'm particularly fond of both topics, but let's start off with Kevin from Consilience Ventures. First met Kevin a few months back as I was asked to be the MC in a room very similar to this for a topic regarding tokenizing sweat equity. Oh, tokenizing sweat equity, that's an interesting topic. What that's all about. The idea there is that sweat equity that we all put in a lot of startups and scale-ups overall, and we get the promise of maybe, startups and scale-ups have no money, so they can't compensate you in cash. So there's the promise perhaps of some shares or something that may or may not pan out. So it's a problem that needs to be solved, and Kevin proposed a whole series of solutions that I thought were really interesting. Well, it turns out that's just the tip of the iceberg, that this whole idea of tokenization and moving cryptocurrencies and that whole world into the world of equity is changing really rapidly. And what we're dealing with here is one of the thought leaders in the space. So talking about the subject of bringing smart liquidity to the VC and PE markets, and particularly noteworthy as it dovetails into the work that we're doing on fund manager and how things are going as well. So let's hear from Kevin this morning about his thoughts on how this world is going to progress and what's happening overall. So with that in mind, please, let's welcome Kevin.
Thank you very much, Rick. It's always an honor to be here. Hi, everyone. I'm Kevin Montserrat, and I'm delighted to be here today. I've actually been very excited about all of the developments that Strategy Tool has been doing recently, certainly around fund managers. I can't wait to play the game. If you have not seen what they've done, check it out, and I would love to play as well, to be honest. Very quickly about myself, I'm an entrepreneur and I have been working in startups for the past 10 years or so. I've started to raise my own funds and started to raise my own equity round for some startups I've worked with, and not everything worked well, and it happened that actually it doesn't work very well for everyone. So what I'm trying to do today, I'm going to bring a few slides, but I'm going to be very short on the presentation because I would prefer this to be a conversation as opposed to be just a one-way street presentation, because we are on the bleeding edge, perhaps we are on the cutting edge of innovation here, and by no means we as Consilience Ventures, we pretend that we are 100% understanding all of the various ramifications that comes with tokenizing the private markets. Yeah, I think the sky is the limit, and then there's going to be lots of new applications built on the top of tokenizing private equities and VCs, and we're just scratching the surface. So let me just share my screen. And just let's get started. So what are we talking about when we want to bring smart liquidity to the VC and private markets? The first idea that comes with tokenizing assets, it means enabling VCs to scale. It means enabling VCs and investment firms like family offices and syndicates to really be able to see more companies and to add more value to their companies. We're not only looking at only creating liquidity for the limited partners, we're also looking at adding more value to the underlying. That's a very, very important point to look at here, is that it is not just about creating liquidity, it's about adding more value. And for this, we need the tools, and we also need to democratize access to venture capital, because if we tokenize those assets, it means that more people can have access to them. So if we start just at macro level, the private markets, it's a $6 trillion market right now. And the VC market is 10% of that. But what's interesting is that this market is so liquid That's only 2% of the transactions are happening on secondaries. So the volume, the size of this market right now is becoming a real asset class. More and more people, more and more limited partners, and more pension funds will look at having lots of VC in their portfolio. So what we need to do is we need to look at why the liquidity matters in the first place. And for this, we need to look at the cost of trading illiquid assets. And if we look at this chart here, we're seeing that actually the VCs, they're typically losing between 20 to 30% of the value of their portfolio on a secondary market. Why? Because it's extremely hard to value a private equity portfolio. And this is the reason why VCs are losing money down the road. It's because they've got to sell at whatever, the price of someone is willing to pay for the fund. But if you make this market more liquid, you're obviously increasing the performance of the asset because you've got a lot more flexibility that comes with it. There's another trend that is important to look at, is that the private market is becoming more and more important, bigger and bigger, and the public market is shrinking. And this is forcing investors to turn to crypto because there is less and less opportunities, and everybody cannot put everything into all of the top stocks. People tend to try to invest in assets that can deliver returns, and that's why the crypto market last year hit $1 trillion, first time ever. So we have those macro trends that is important to consider when we're looking at creating liquidity. But when we look at the micro level, raising a fund is extremely painful. It's extremely long. You need a track record, and you need to show that you need to be able to show that you have access to the companies that you're raising the money to invest in. So the other factor that I think we need to look at is this correlation between time spent on due diligence and return on investment. And this is very, very difficult for VCs because, as you know, VCs are usually small teams, and small teams means little capacity to spend lots of time with many deals. And as the size of the funnel increases, because there are more companies being created every year, we're creating more and more companies, it becomes harder and harder and harder for the VCs to look at those companies and then assess which ones are the best ones and which ones are not worth to look at. So given that there is a correlation between the return on investment and the time spent on due diligence, we've got to improve the selection process. So we need to go beyond the tokenization, but we also need to implement tools to be able to effectively accelerate the whole process. Especially because when we look at basically the adverse selection process, when VCs issue term sheets after other VCs, they're far less likely to win the deal. And therefore, they are entering into the deals after the others, or they are basically not invited to participate. So the conclusion here, just to wrap it up, the conclusion is there is a big VC dilemma. There's that VCs are small teams, but the more time they spend on deal, the higher the return on investments. But they've got small teams, and they've got to be able to rebalance that. We need to enable VCs to spend more time on reviewing companies, but reviewing more companies at the same time, because it becomes even more competitive. The VC market is increasingly competitive. There's now 900 micro VCs, according to Kaufman. There was only 100 in 2012, and then the time to IPO is now almost 3 times what it was 20 years ago. So all of these are signs that the VC model has to evolve. We need to now enable VCs to create better investment strategies and then to have various tools to help them to do better with their portfolio companies and to create more value to their limited partners. And this is why we are coming to the tokenization part. It's because with the tokenization, with the increase of efficiency and with the increase of performance gained on the secondary, we are enabling VCs to leverage their network faster, give them skin in the game, and spend more time on reviewing and accelerating companies and add value to their portfolio companies. So that's one. Tokenization will reduce the time to select and to add value to companies without decreasing the quality of the work. But there is another, of course, element, which is the liquidity. By opening the liquidity, by creating VCs, more liquid VCs, we will obviously open the pool of capital available, and more capitals mean more capacity in VC world. And we also democratize access to venture capital because everybody should be able to invest in VCs at low risk. And as I explained earlier, as we saw, given that there is a saving on the secondary market, the fund is going to outperform, and it's going to, a fund that outperforms can charge their limited partners more. So here's one example of how you can tokenize a venture fund. This is actually very simple. Instead of having the carries and lots of legal work, what you would have is you would have a tokenized fund structure plus a software to manage those tokens and also to manage the community and manage the portfolio. So the investors effectively, instead of putting money into a limited partnership, they buy tokens. Okay, they buy tokens, and those tokens, where do those tokens come from? They come from the tokenizations of the underlying. So you tokenize the underlying, you create one token for the entire portfolio, and this token becomes effectively tradable, which is why it makes it more liquid. So you'll have the whole community of the fund that will be able to work for the fund, and not only the team of the fund, and everybody is aligned. So once we have tokenized this fund, what if we do it with more funds? What happens if we start to tokenize all the funds and we create a global liquid private market, enabling VCs to empower their communities and to leverage their network much better, to review more companies and to add more value to their portfolio. And that's what you have seen recently with Sequoia, for example, proposing a more liquid fund. And that's why Andreessen Horowitz is heavily investing in the next generations of exchanges. Is because the private market is headed to be like the public market. Now, one of the benefits of tokenizations, the way we look at this, is that we do not need to change the fund structure. Whereas right now, a lot of solutions that were proposed to the VCs were forcing the VCs to change their fund structure, and the limited partners don't like this. So what we need to do is we need to keep the same structure, but we need to enable the funds to scale. We need to enable those funds to have predictable cost and to industrialize the workforce sweat equity model. But that cannot be done only through tokenization. We need to build all of the software. This is just the overview, but we need to build all of the software on the top of the token to really create value to the token. So you'll manage your deal flow, you'll manage your network, you'll manage your portfolio, your communication, your due diligence, all in one place. So I'd like to finish with this. I believe that today, the fund performance, theoretically speaking, it's a combination of network quality, engagement, valuation, speed of the transactions, value added, and branding. The next generations of VCs are going to be including the data, the automation, the liquidity, and the pool of capital access. And I will just finish it here, and hopefully, let you engage, debate, ask questions, and challenge me on any of this. Remember that, as I said earlier, there's so much here to learn and to uncover that, I'm sure we're going to learn from this session, and I will learn as much as you do here.
Thank you. A lot of information there. I mean, you're revolutionizing so many aspects of the entire VC and PE industry. So I'd like to direct some questions and sort of break things down a little bit. Interesting that you took the first half of the discussion talking about advantages and the advantages of efficiency, time saved, the ability to increase overall capacity for due diligence, things along those lines, and then the prospect for liquidity. And then the second half talking about structure, and kind of some questions on both halves. I'll start off with one coming out of the chat from Stefan, which says, Kevin, can you elaborate on how tokenization adds efficiency or increases efficiency? Really didn't get that point. How does tokenization allow investors to have more bandwidth to go off and do due diligence and things like those?
Sure. I'm going to be very, very simple. I'm going to give a simple answer. Today, if you want to trade anything, you've got to go to a lawyer. You've got to go through a pile of documents, and you've got to basically get everybody agree that we're going to change the contract. If in this contract you say that this token can be liquid and you can trade it with someone else, then the time to trade this asset is reduced massively. So that's true for funds, and that's true for startups. So the efficiency is the time that is reduced to the minimum time of the transactions. We're very much looking at, a massive improvement in terms of time to transact a securities effectively.
Okay, so it's actually
but there's another element to that, because tokenizations comes with blockchain and comes with data, and therefore, if more data are available to me, then I'm much quicker at making a transaction. And if I've got the guarantee that the data is immutable, that nobody could have changed the data in this, in this contract, nobody could have changed the term of this contract, then I don't have to double guess. I know that this is what I'm presented is real, and with that, I can then, of course, buy, given the information I've got access to.
Okay. So it's transactional efficiency, the fact that it doesn't take days or weeks to close something and all the attorneys having to go through data rooms and sign documents and everything. It is.
And the cost, of course, because I don't need to go through a notary or a lawyer to do that, because I can just simply just buy, and it's there's no transaction cost neither.
Okay, cool. Another question, what's the regulation of tokens? UCITS in the EU?
So that will vary from one jurisdiction to another. We treat security, we looking at the law, the securities law, and we treat those tokens as securities. So we are applying the securities law and all of our legal framework is based around the fact that this is a security. So there's there is an argument to say that this could be a utility as well, like those tokens can have utility as well. But the reality is that so long as you are expecting to receive some cash against those tokens, you've got to treat them as securities. So it's not as complicated, it's not more complicated. Where it becomes more complicated is when you have utility values, and with some kind of securities, the reality is that we're treating this as securities.
So if that's the case, which jurisdiction do you think is most likely to see these kinds of transactions happen? Is it Europe? Is it the US? Or
Europe is ahead globally. Europe is way ahead, everyone, because the regulation, the market is not as fragmented as in the US. In the US, you've got 7 regulators, and it's just very complex. But of course, when the US is going to make the move, probably a lot of people will follow what the US is saying. But the reality is that for now, Europe is more innovative and more responsive than the US market. However, we work in the US, and we've managed to register at the SEC and work with US investors. So long as you can passport and you can trade those tokens with anyone connected to the internet, then you can deal, all over around the world without, of course, with the obligation to respect the local authority and local obligations.
Cool. I'll turn it back over to the group at large, but within Europe, is there any particular country that's moving forward faster than others? I have my guess, but I'm interested in your opinion.
Well, I'm based in London, and I'm not going to have that bias. I think the European market has not made any major change. I mean, I think Europe on that front is still unified, and I don't think there is any country that is doing better than the others. There are just simply some countries that have more influence than the others in Europe. But the bottom line is that I think it's a coordinated effort, and not one country is coming with more favorable terms than the others. Of course, some countries are doing it. We'll see it in Dubai. We'll see it in a lot of jurisdictions where they are going to come with a lot more flexible rules.
I'll just watching time here. I'll wrap up with one question. So the chain starts off with companies issuing tokens. Those become the currency by which then an investment is made. Fund then has multiple investments in tokens. Those become the currency by which the LP is able to receive their compensation. What's the tipping point? Does it take a group of individual companies to go ahead and start issuing equity as tokens, or how does this? I think the chain seems bottom up, but do I have that right? And if so, how does that start?
The short answer is we do what we want. The token is what we make it, what we want them to do. So tokens are digital contract. Another way to look at tokens, would be to look at how we deal with share classes. Yeah, you can have in one company, you can have lots of share classes. It's the same thing with tokens. You can have one token that gives you this right and these obligations, and this token that has completely different rights and all obligations. We do what we want. Cool. There's no limitations. We can be very creative.
We can do what we want. Good answer. I like that. Well, cool. We could go on for hours. I could go on for hours. I apologize for sort of occupying the stage here. People, if you out there in the audience, if you have any questions you'd like to address to Kevin, go ahead and post them in chat, and we'll have a chance to take those as we go during the next conversation. So thank you very much, Kevin.
Thank you very much.
Yeah, wonderful. And also, Kevin, if you can put up your contact information in the chat as well, so people can reach out, that would be awesome. Super triple awesome.
Thank you very much. Just to answer the question to Stefan, Avant-Garde is for DAO. It's decentralized autonomous organizations. The reality is DAO, it cannot work in a regulated environment. We have decided to centralize all of the regulation because someone has to go to jail. And in DAOs, if there's no one that goes to jail, you're never going to be able to work with the government. So my short answer to you, Stefan, is I know lots of companies doing DAOs. We're using the same principles, but the reality is that we're playing with the regulators and we are agreeing with what the regulator says.
No one wants to go to jail.